Herd mentality, also known as herd behavior, is a significant phenomenon in the stock market, where investors collectively follow the actions of a larger group rather than relying on their independent analysis. This behavior can lead to substantial market movements and has profound implications for both individual investors and the broader financial system. Understanding herd mentality is crucial for investors as it influences market dynamics, investment strategies, and risk management. This comprehensive exploration delves into the psychology behind herd mentality, its effects on the stock market, historical examples, and strategies for navigating its challenges. Understanding herd mentality. Herd mentality in the stock market refers to the tendency of investors to mimic the actions of the majority, often driven by emotions such as fear or greed. This behavior stems from the belief that the collective wisdom of the crowd is more reliable than individual judgment. Herd mentality can lead to rapid and exaggerated market movements, as investors rush to buy or sell based on the actions of others rather than their analysis. Several psychological factors contribute to herd mentality. One key factor is the fear of missing out, FOMO, where investors are driven by the fear of missing out on potential gains if they do not follow the crowd. This can lead to impulsive buying decisions, especially during market rallies. Conversely, the fear of loss can drive herd behavior during market downturns. Investors may sell off assets in panic, fearing further losses, which can exacerbate market declines. This behavior is often reinforced by negative news and media coverage, creating a self-fulfilling cycle of fear and selling pressure. Social proof also plays a role in herd mentality, where individuals look to others for cues on how to behave in uncertain situations. In the stock market, investors may assume that the actions of the majority reflect superior information or insights, leading them to follow suit. Effects of herd mentality on the stock market. Herd mentality can have significant effects on the stock market, contributing to increased volatility and the formation of market bubbles and crashes. During periods of exuberance, herd behavior can drive asset prices to unsustainable levels, creating speculative bubbles. As more investors jump on the bandwagon, prices continue to rise, often detached from fundamental values. The dot-com bubble of the late 1990s is a classic example of herd mentality driving a market bubble. Investors poured money into technology stocks, driven by the belief that the internet would revolutionize industries and create unprecedented growth opportunities. This speculative frenzy led to inflated valuations, which eventually collapsed when reality failed to meet expectations. Similarly, herd mentality can exacerbate market downturns, as panic selling leads to sharp declines in asset prices. The global financial crisis of 2008 provides an example of how herd behavior can contribute to market crashes. As fears of a financial meltdown spread, investors rushed to sell off assets, leading to a downward spiral in stock prices. Herd mentality can also impact market efficiency and liquidity. During periods of intense buying or selling pressure, market prices may not accurately reflect underlying fundamentals, leading to mispricing and inefficiencies. Additionally, herd behavior can strain market liquidity, as the rush to execute trades can overwhelm market infrastructure and lead to increased transaction costs. Historical examples of herd mentality. Throughout history, numerous examples illustrate the impact of herd mentality on the stock market. The South Sea bubble of the early 18th century is one of the earliest recorded instances of herd behavior driving a speculative bubble. Investors flocked to buy shares in the South Sea Company, driven by exaggerated claims of potential profits from trade with South America. The bubble eventually burst, leading to significant financial losses. The 1929 stock market crash is another example of herd mentality contributing to market turmoil. Leading up to the crash, a speculative frenzy drove stock prices to record highs, fueled by margin trading and the belief in endless economic growth. When the market turned, panic selling ensued, leading to a dramatic collapse in stock prices and the onset of the Great Depression. More recently, the rise and fall of cryptocurrency prices in 2017 and 2018 demonstrate the impact of herd mentality in modern markets. The rapid increase in Bitcoin and other cryptocurrencies was driven by a fear of missing out as investors rushed to capitalize on potential gains. When prices began to decline, panic selling led to a sharp correction, highlighting the volatility associated with herd behavior. Strategies for navigating herd mentality. Navigating the challenges of herd mentality requires a disciplined approach and a focus on independent analysis. Investors can adopt several strategies to mitigate the risks associated with herd behavior and make more informed decisions. 1. Conduct independent research. Investors should rely on their analysis and research rather than blindly following the crowd. By understanding the fundamentals of an asset and assessing its intrinsic value, investors can make informed decisions based on objective criteria. 2. Diversification. A well-diversified portfolio can help mitigate the impact of herd mentality by spreading risk across different asset classes, sectors, and geographic regions. Diversification can reduce exposure to market volatility and protect against sudden price movements driven by herd behavior. 3. Maintain a long-term perspective. Investors should focus on their long-term goals and avoid making impulsive decisions based on short-term market movements. By maintaining a disciplined approach and sticking to a well-defined investment strategy, investors can navigate market fluctuations with greater confidence. 4. Use stop-loss orders. Implementing stop-loss orders can help manage risk by automatically selling a security when it reaches a predetermined price level. This can prevent significant losses during market downturns and provide a measure of protection against herd-driven sell-offs. 5. Be aware of market sentiment. While it's important to conduct independent analysis, investors should also be aware of market sentiment and the potential impact of herd behavior. By monitoring sentiment indicators and media coverage, investors can gauge the mood of the market and adjust their strategies accordingly. 6. Stay informed. Keeping abreast of market developments, economic indicators, and geopolitical events can help investors anticipate potential shifts in market sentiment and make informed decisions. By staying informed, investors can better understand the factors driving herd behavior and position themselves accordingly. The role of technology and social media. In the digital age, technology and social media have amplified the impact of herd mentality in the stock market. Online trading platforms and mobile apps have made it easier for investors to access markets and execute trades, increasing the speed and intensity of market movements. Social media platforms have become powerful tools for disseminating information and shaping investor sentiment. Influential figures, forums,